Welcome back, everybody. Welcome to another Study Wealth podcast episode. I say this a lot, but this is really very special. I've had a lot of conversations with clients who've been looking forward to this one. So it's my great honor to welcome Nancy Davis from Quadratic Capital Management. Nancy, it's great to have you here. How are you?
Thanks for having me. Great to be here with you.
It's a story that we have been discussing with our client base a lot about the higher inflation for longer. I know you are very much focused on that, and I'd love to talk about this from almost a little bit of a different angle than how we've been focusing on with our listeners for a while. But first, give us a little bit of background about you. You're on CNBC all the time. I told you I've been following your work for quite some time. People probably know you, and certainly the people I've been telling you about this interview, they're all looking forward to it. Just give us a quick rundown of sort of your experience and how you're coming into this world.
Oh, well, you're totally making me blush. Yeah, I'm an inflation expert. I specialize in the interest rate markets and the bond markets on the fixed income side. And I've been I founded Quadratic Capital 12 years ago. And prior to that, I spent the majority of my career at Goldman Sachs, where I was the head of credit rates and derivative trading for the prop desk. So we had no client capital, no Goldman clients. It was just Goldman's own money.
Yeah. So the prop desk, I used to always envy. I was at J.P. Morgan and on the credit side, and I used to always envy the Goldman guys. I always felt like they were just a touch smarter. so that's my story. No, but in all seriousness, the inflation story that we see, and I say story as in like, it's kind of what we see as a base case of higher inflation for longer. I keep reminding people that inflation does come in sort of almost secular kind of waves, and just because we haven't had real inflation, I'm not talking about 10, 20% runaway inflation, but something just north of the 1 to 2% that we've had for 30 plus or so years, maybe 3 to 6. We'll see. It's hard to make a forecast here, but it always requires a different portfolio, or at least somewhat of a different focus. But I didn't actually know that Quadratic was already in business for 12 years, so that's amazing. What is your take on this? I know we can start this in so many different angles, but give us sort of your starting point and where you come down on all this. I know your slogan, and I'm using it as well, is you want to be long and you want to own inflation, right?
Mm-hmm. I think so. I think, look, at the end of the day, the inflation markets are pretty new. A lot of people look at what happened in the 70s and 80s, and the inflation markets did not exist back then. So a lot of people look at oil because of the embargo and gold because it had one good year. And I'm not saying those are bad instruments, but there are other ways, and I'd say more pure play ways to access inflation. The inflation protected bond market didn't even start until the late 90s. So if you're only looking at things that worked in the 70s and 80s, you're going to miss the inflation markets. And then the rate derivatives markets really started in kind of the 2000s. So these are new markets. But I think it's a more look, it's hard to know what would actually work in an inflationary environment. But I think for me personally, I would want to own a lot of different things inside the portfolio. And I think the key is that most investors are benchmarked because of, after the financial crisis, the target date funds, all the defined benefit plans, they've all moved to the passive index replication world, and core fixed income, their benchmark has no inflation protected bonds, zero. So most people who are just sitting in core fixed income, especially in passive, they don't have any exposure to the inflation markets. Yep. And to me, I think that's a mistake, especially because inflation expectations are so low right now. They're really symmetric around 2%. I'm just peeking at my Bloomberg to get you today's levels, but the 1 year break even is 1.39. The Fed is targeting 2. And it's just, I think, a good opportunity for investors to say, look, I don't know whether inflation has been won or not, but it's priced to fall dramatically in the future. And I think it's a good time to add it as part of a diversified portfolio.
Yeah. It seems like when you look at sort of the mainstream media, maybe as just one pocket of specialists or focus, there's a lot of talk about how inflation is kind of defeated, I think is some of the words I hear. Um, so I'm assuming, and not to put words in your mouth, but you probably not in that camp then.
Look, I think a lot of people are thinking of inflation as a trade, right? And I like to remind people, we live in a real world and everybody has, whatever industry or job that you're in, you save money and invest it. And the goal is to be able to one day retire and maintain your cost of living and live off that investment income and have enough money not to run out, right? So I think for me, I think the fact that inflation is priced to fall, the Fed is cutting rates. We can argue about whether they should be cutting or shouldn't be cutting, but the reality is they are cutting. And no matter who wins the election, which is amazingly, it's only in 25 days, I think either person, we're going to be spending a lot of money on the fiscal side. So to me, I think the inflation markets are just something people shouldn't think about whether it's going higher or lower, because we live in a real world and we have that risk in our real life. And I think the big problem with using just the inflation protected bond markets, we own inside IVOL, we own 80% of our fund is treasuries. We use treasuries that are linked to inflation, but the only index to calculate inflation in that market is the consumer price index. And nobody would buy the Dow Jones or the Russell or the NASDAQ and say, ta-da, I have the equity market. And it should be pretty easy to measure the equity market because there are not that many publicly traded stocks. Inflation is just a lot harder to measure. And so that's what we do in IVOL is we take 80% treasuries and then we add another measure of inflation expectations using the interest rate markets, which are huge markets, and most people can't access the rates market on their own.
Yep. No, and that's actually a great point because we live in a our listeners are to a great extent somewhat self-directed, a bit maybe more on their trading account than their investing account, although it's morphing more and more into just one big bucket of trading and investing in one thing. And so I think there's a huge focus, and we know the AI story and all that stuff, but a lot of people are, kind of high on that wave, but not really focusing on what else is out there. But it's really interesting, Nancy, when I talk to people about different ideas, the one thing that over the really year to date and probably maybe the past 18 months, the one thing that everyone immediately understands, grasps, and is interested in is this story of how do I own inflation? How do I not get hurt by inflation, at least in the portfolio?
Yeah.
And how do I actually maybe make money from it? But there's things that are kind of obvious to some people, maybe some commodities, maybe the energy sector. Again, this is a very wide, there's a lot of different ways to allocate this, but what you're focusing on, and I should mention, is you run an ETF called IVOL and another one as well.
Not eyeball. Yeah, I have it's like inflation volatility or
Yes,
interest rate volatility.
IVOL, exactly. The ticker symbol is IVOL. Our listeners
Yeah,
should
it
be
sounds like
very familiar with
eyeball
it.
when you say it, right?
IVOL, yeah, no, it's IVOL. Our listeners are very familiar with it. I talk about it a lot. It's in a lot of the different educational products that we offer as well. But you're focusing on a very different market than if people were to just buy a basket of inflation kind of stock. Because people look at sectors, and we live in an equity culture here in the United States. But you're focusing on the derivatives market, or particularly in this case, it's fixed income. But maybe you can go a little bit, maybe not too deep, because it's people's eyes are going to start, But maybe talk a little bit about what actually is it. Maybe basics of tips, and then kind of how you take advantage of that. And we do have to touch on the yield curve, of course.
Yeah, so we just access another asset class. I mean, I think most, I would say regular investors, because of passive indexing, they have equities and then they have bonds, and they might have bonds that are treasury bonds or bonds with credit risk, but we access like a third asset class, which is the rates market. It's something different. It's a newer market than the stock market, but to me, it's one of the largest markets in the world, and every single corporate sovereign, if you're a government of Saudi Arabia and you're selling your dollars and your debt in dollars, you hedge yourself in the swaps market. You're not
Right.
sitting there saying, geez, I hope Jay Powell does this with rates. You're not speculating on it. So it's a really large market. And prior to the savings and loan crisis, the entire mortgage market was OTC, meaning it was over the counter. It was not accessible for regular people. And then QSIP came out and QSIP'd all the mortgages. And now mortgages make up, about 25% of core
Yeah.
fixed income, the AG index. And so we see this as very similar to QSIPing the rates market, but with a mortgage, your homeowners are on the option to prepay. So if you own the
Mhm.
ag or a mortgage inside of your portfolio, which most people do because of passive indexing, you're actually short options to homeowners. And whenever you're short options, you're short vol. It's not equity vol, it's actually fixed income vol. And so we think I vol is a really nice complement, because I don't think a lot of people realize that they're short volatility in their bond portfolios, right? That's kind of
Yep.
shouldn't
No.
be a surprise, because every single blow up usually starts with short vol in financial markets. But this is a nice way to not only be short volatility in your bond portfolio.
Yeah. I mean, this what you're touching on right there is very close to something that I almost preach every day, which is the whole short vol trade, and this expands way into the equity space as well. As now, that's not what we're talking about here, but there's a lot of interesting stuff going on there that people entertain themselves with. But yes, the short vol, and then ultimately the credit markets tend to see some pain. But this isn't. I think the point what I'm trying to get to is when we look at what you're offering here, or at least we're the expert on. This is not a market that the a retail investor can really access directly, right? And I think that to me, that's why this is so interesting. I was a credit default swap guy, and that's still something that's completely untouchable by the retail investor, even indirectly for the most part. But you offering something here that one can essentially benefit from higher interest rates for longer, at least in part, a steepening yield curve in part. And I'd love to touch on that as well. And I think that's what makes it so interesting, giving people more access to different things than just being long U.S. tech stocks. To keep it
Yeah,
simple.
I'd say the nice thing about ETFs, if they
Mm-hmm.
trade on exchange, so ours trades on the New York Stock Exchange, and anyone can buy it, whether you're an endowment, Australian pension fund, your mom, just to pick an example, like anyone can access the uh, listed markets. And
Yeah.
so we see this interest rates are not something that most people have exposure to in their financial portfolio, but they have exposure to it in their real life, because most people, if you're a renter, you're exposed to obviously rising rent prices because you have to renew your lease. Or if you're a homeowner, you're exposed to interest rates. And so, kind of, everyone implicitly has that rate sensitivity. Most professional real estate investors will hedge their rate risks, but regular people can't. And so, we see this as a nice way of, complementing core fixed income to add inflation, because the ag index has zero inflation
Yeah.
protected bonds inside of it. Also a way to capture and access the rates market, which, all investing involves risk. There's nothing that's risk free, but this is something that most people don't already have in their portfolio, right? If you have, a bunch of equities and say corporate bonds, most people have something that looks like a 60-40 portfolio. So this is something different.
Yep. No, it really is. And I think that's where, I'm always trying to talk to people about this is through the lens of education here, my end, how do you, in terms of the inflation story, how do you diversify that? Because initially when the conversation comes up, it's okay, I'll just buy some gold. or I'll just buy some,
Yeah.
I'll buy some whatever else, right? And it's not just that. Like there's a whole thing here that one could allocate to quote unquote profit from this inflation, and this is very unique, right? I think that's why I keep coming back to what you're doing with eyeball. Could you possibly touch a little bit on the yield curve and the steepening of that and how that may affect the trade? Because that's something I'm talking about a lot, and it does resonate with people once they understand what the yield curve is and maybe how important it is.
Yeah, so I would just say the Fed controls the overnight rate, the Fed funds, so they control policy rates, but the market controls interest rates at different points in time. So, today, for instance, you look at the twos tens yield curve, what we access inside of eyeball, it's actually negative 15 right now in the spot rate. So that means 10-year interest rates are 15 basis points lower than 2-year interest rates. And to me, that's not normal. That means the world is willing to, give and finance our debt and give us a loan for longer and get paid less to take more risks. So it's not normal to have an inverted yield curve. The treasury yield curve has started to, go, it's still very flat, but it's a little bit positive now. The rates market, which is what we access, is still negative in the spot curve. And we think that's a really unique opportunity for people to be able to buy. There are not many things that you can buy in the financial markets today that are trading at valuation levels from around the 80s, and this is one of those things that is very cheaply priced, in my opinion.
Yep. No, and I think, and when I explain this to people, this concept, it does resonate with people. It's at the end of the day what we're seeing here, in terms of the yield curve, and we've had twos tens on the treasuries. It went back into, was it like 20 basis points plus or something
Mhm.
at some point here a little while ago. But it resonates with people that borrowing money for longer shouldn't be cheaper than on the
Yeah,
short.
it's like if you lend your neighbor money, for a week
Yeah.
versus 10 years, you would expect to get paid more. And that's what we access. We access the yield curve to give us another index to capture inflation expectations beyond just the consumer price index. Like, I think, we listed the fund over 5 years ago in 2019. And at the time, it wasn't very, kind of common knowledge that the Fed doesn't use the CPI.
Mm-hmm.
Now it's become much more common knowledge that the Fed might look at core or they might look at PCE or survey data, but the CPI is just kind of a very narrow way to look at inflation markets because everybody's basket is personal, right? Like what kind of where you have your risks. And so we think the interest rate markets is just a nice way to get kind of a more diversified basket because the big problem with the CPI on its own is so much of the basket is the owner occupied rent. So that shelter component makes up about a third. And not everybody needs that in their inflation basket.
Right. Yeah. I mean, down here in Florida, I'm in Florida right now. There are a lot of baby boomers, and a lot of them have paid off the mortgage, so they don't really care all that much about some of those things anymore at this point. Um, the other thing that I thought we could just quickly touch on is how do you, and this is not a portfolio construction exercise, but when you look at this, I mean, and you try to build a portfolio, or you try to add on this inflation thing. I mean, again, there's so many different ways of adding exposure, owning inflation. I just love how you say that because it's so
Mhm.
true. I mean, how do you slice and dice this? So eyeball, or this idea of where you're accessing with eyeball, I mean, is that something that should almost replace other parts of an inflation story? Or how do you kind of look at it? I know we're not giving advice here, right? This is more, I'm just trying to get people to have some idea of how do you kind of put this into a portfolio.
So it's a inflation protected bond fund. So it tends to sit on the fixed income side of people's portfolio. It's paid a monthly distribution of at least 30 basis points every month for over 5 years. So that's the historical distribution. So some people will say, look, we have a lot of equity risk. Equities are, near, all-time highs. And
Sure.
in our fixed income bucket, we don't want to have as much credit per se, because credit, like if you think about it, if you own, Apple stock and Apple bonds, you really have the same, I'd say corporate beta, right? You just have a different part of the capital structure with a corporate bond. So instead of adding more corporate spread, people will say, look, we'd like to add IVOL, which is interest rate spread, just something else. It doesn't take any corporate credit risk. And credit spreads, like if you own a bond that's, say, investment grade, you really have two ways to win. You want yields lower and you want credit spreads tighter. And credit spreads are very, very tight right now. So especially short duration, that's one of my pet peeves, is a lot of people I feel like are rushing into short duration and don't really get that, the short, like let's just take the investment grade CDX. I know you used to be a CDS trader. It's 22 basis points right now. So, it can only, like best case scenario, it goes to zero, right? Which is unlikely.
Yep.
So it's just a lot of risk with not a lot of potential reward.
Yeah. I mean, what I don't even know. Like, I haven't looked at it in a while, but I mean, high yield default risk, sort of like long term average is like 3-4%. I don't even know where it is right now, but it's got to be pretty low as well. I mean, but I think what I'm trying to get to, and you're doing a great job, making people sort of focus on this. This is something that's a different way of tapping into owning in inflation as opposed to being shorted. I also forgot to mention before, and thank you for bringing that up as well. IVOL pays about a 30 basis points a month, so let's call that 3.5, 3.678% yield per year. So this is not just a directional product; it's really there's an income play there, for lack of a better term. I don't even know if that's compliant with what I'm saying, but
If you go to, I see you have our ancient quadratic website up. We have not updated that in 10 years. But if you click on the eyeball tab, that's the fund page.
yeah,
So that one has, kind of, that's an updated website and has all of our, this is a 1 minute video. It actually has sound if you unclick. You
yep,
don't need to do it now, but
sure,
for your audience, if they want to check out what the fund is, like the prospectus, SAI, all the materials are listed on the fund, but it's a way to benefit from either the Fed cutting rates, so it benefits from lower short-term yields, or rising long-term yields. So it's sort of a spread trade that accesses inflation expectations outside of just the consumer price index.
yep. No, it
And
does, and and I should also mention at this point, just so people know, like this is not a sponsored message. Like I'm not
yeah,
paying Nancy, she's not paying me. I really, if you're a listener of ours, you know how much I've talked about this product before, and so I just wanted to have, and I'm very honored to have Nancy here to talk about this for us. Well, I mean, I think we've kind of covered the basics. Is there anything else that you think we should cover to kind of explain to people what this is all about? And diversification, I think, is one of the main things here in owning inflation.
yeah, I think it's to me it's something that people really, if you don't own inflation in your portfolio, in my mind, you're actually short it in your real life. Like I think that's kind of the message I'm trying to bring out. And then I think it's just so important for people to remember that because of passive indexing, which nothing wrong with passive investing, but core fixed income is really not as, core as it sounds by name, because of the mortgage exposure. It's only short fixed income vol, and then there's no inflation. So I think a lot of people will just say, okay, we'll take our core, maybe the ag index, and then they'll add IVOL to add inflation expectations with CPI and inflation expectations in the rates market, and to help reduce that embedded short optionality. Because think about it, if you own a mortgage, the homeowner is long the option to prepay. And so whenever you're long an option, you're long vol. Whenever you're short an option, you're short vol. And so I think a lot of people just don't think about, since it's a single CUSIP product, that it has that embedded short optionality inside of it.
For sure, and I would also add, and I'm not. This is not coming from you, and just from my perspective. A lot of people that we speak to are, we live in an equity culture here in the United States. Certainly on the retail side, there is a lot of you also short a lot of inflation or not long in plenty of equity parts of the market. So that's another thing. And so to me, this is something that complements an equity exposure, not just in a fixed income portfolio. It's just the whole thing about inflation. So
Yeah, and I think at the end of the day, if you think about like what people are trying to do when they do portfolio construction, you want to have different things because like we just don't know, you know, how markets are going to go, where monetary policy is going to go, what the fiscal side is. And I do think the biggest risk to a 60-40 portfolio is actually a stagflationary environment. And obviously, look, the inflation protected bond market did not exist. It only started in the late 90s. The interest rate, what we access in IVOL didn't exist back then. But I think when you think about the components, I think this is something that could potentially really work very well in a stagflationary environment. So I think, that's also something to be thinking about because there's no guarantee that, things are priced pretty well right now. And I think it's a good time to look at diversifying assets.
yeah, it's all about looking where the puck is going, right, as opposed to where it is.
Yeah, and I think just being prepared. Like you just don't want to have all your eggs in one basket. And I think especially most people, like the bulk of people's equity and their net worth is really in real estate, and the real estate markets have been on fire since COVID. But it's going to be interesting to see with the Fed cutting rates, whether there's more supply, whether what happens to property prices.
Yeah.
I think
No,
everybody feels really rich right now, right?
very
If
very
you're a
wealthy.
homeowner, or you feel really poor if you're not.
And that's the K shape, right? But I agree. I mean, when I speak with like mostly our listeners, there's certainly a wealth effect in terms of how people feel, and it's clearly understandable. Everything's gone up in value for the most part, including our groceries, right? So that's why we're having this discussion here. But Nancy, again, great pleasure. You guys can check her out at ivoletf.com. Thank you so much for joining, and I hope to speak again soon.
Thank you for having me. It's great to discuss with you today.